you to this panel on the future of finance. Let me first start off by saying a huge thank you to the IMF for inviting all of us to join Mr. David Lipton on this panel to talk about one of the most pressing issues of our time. I'm going to do a little housekeeping, introduce the session and the panelists, and then we'll get going. So the first bit of housekeeping is to say the session is being live streamed. So please can I ask all of you to put your mobile phones on silent. I wouldn't presume to tell you to turn it off, and I don't want you to turn it off because I want you to tweet. The hashtag, as you can see behind me, is #FutureOfFinance. So join the conversation, whether you're here or watching from around the world. We'd very much welcome that. So in terms of this session, we are going to be talking about charting new waters in the next decade. So this is a very special panel comprised of policymakers from around the world as well as market participants. We're going to cover three aspects of this topic with you this afternoon. The very first is how has the financial system changed over the past few years? And importantly, how is it likely to evolve? And then finally, how should policymakers address these evolving trends and challenges so that we have a robust financial system that supports strong economic growth? So we will be covering issues including demographics, the aging issue in a number of economies, what that means for pensions, insurance, the growth of non-financial institutions. We will also be looking at global integration issues, as well as climate, what that means for green finance. So it's a large set of issues, all of which will be affected by technology and innovation. But we won't be focused on fintech, as there has already been a terrific discussion on that issue here at the IMF World Bank meetings. So, without further ado, let me introduce my panel. David Lipton, he assumed the position of first Deputy Managing Director of the IMF in 2011. He is now in his second term. Previous to coming to the fund, he was Special Assistant to the President and served as Senior Director for International Economic Affairs at both the National Economic Council and the National Security Council. Previous to that, he was Managing Director at Citi and also served in the Clinton administration. Joining him on the panel is Ryozo Himino. He is the Vice Minister for International Affairs of the Financial Services Agency in Japan. Over the last 2 decades, he's assumed various posts at the agency and supervised banks. He's also served as Secretary General of the BCBS and chaired IOSCO, Asia Pacific Regional Committee, as well as other roles. Now, my favorite part of his bio is that he has published a book applying the Chinese Book of Fortunes to Sophocles' tragedies. So I encourage all of you to pick that up. We're also joined by Governor Karnit Flug. She was appointed governor of the Bank of Israel in 2013, and her 5-year term ends next month. She has had a distinguished career at the Central Bank of Israel, including as deputy governor, acting governor, and director of the research department, and other roles in senior management. Earlier in her career, she worked at the IMF and as a senior research economist at the Inter-American Development Bank. Alicia Garcia Herrero is the chief economist for Asia Pacific at French investment bank Nexus. She also serves as senior fellow at the European think tank Bruegel. She has a number of roles, including as an advisor to the Hong Kong Monetary Authority's research arm and the Asian Development Bank, and she's also currently adjunct professor at the Hong Kong University of Science and Technology. Rounding off the panel is Davide Serra. He is the founder and chief executive of Algebris Investments, a global asset management boutique that manages $13.5 billion of assets with offices in London, Boston, Singapore, Luxembourg, Milan, and Tokyo. He has been awarded the Knight Commander designation, a decoration, the Order of Merit of the Italian Republic. So, Davide, I hope it's okay if I don't call you sir throughout these proceedings. And he also played professional volleyball in Italy, and is a keen alpinist. So I hope you'll agree it is a very distinguished panel with some very interesting hobbies thrown in there. And let me now ask the panel to kick off our discussion. So first, can I ask you, David, to start and just talk us through how the financial system has evolved over the past few years?
Perhaps 10 years after the global financial crisis, we should start by noting that the financial system has survived and that it's recovered, because after all, when we all met, when the IMF World Bank annual meetings happened 10 years ago, it wasn't clear that that was going to be the case. And the task that the international community set for itself then and in subsequent G20 meetings was to make sure that this could never happen again, and to see that a modicum of stability could be built in more firmly in the way in which policy, supervisory and regulatory policy took care of the banking system and eventually the broader financial system and capital markets. Obviously, the world needs successful financial intermediation. Economists like to assume that you've got S savings and I investment, and the savings somehow magically gets to the right investments. But we know it doesn't happen unless you have good financial intermediation, and that can be carried out without interruption, without episodes of financial instability. I think we learned that the banking system was too big and was not being safely managed and supervised, but we also learned that important parts of the capital markets could fail in ways that we never had anticipated. So in the interim, the financial and regulatory agenda has taken on these tasks. I think it's been very successful in many important respects in making sure that banks have more capital, that they have better liquidity, that the supervision is firm, and I think we can discuss this. I think generally speaking we should feel comfortable that banks are being run in a more cautious and in a safer way. We are seeing a lot more of intermediation happening outside of banks with the growth and proliferation of non-bank financial institutions. I don't want to use the term shadow banks because it gives a negative connotation, but clearly there are some non-bank institutions that are very sound, others that are engaging in intermediation that may have some risks inherent. I think we're going to need to be looking at that. This, you said that fintech has been covered in other meetings, but one really can't divorce this subject entirely, because the changes in technology are affecting banks, non-banks alike. There's a huge, there are new financial technologies being used both to strengthen bank and non-bank operations and their interactions with their clients, as well as their performance of back office operations. There are new forms of financial technology that are being used in entities that are not financial institutions but are starting to get into the business of intermediation. This is advancing more rapidly in some parts of the world than other, and not necessarily in the most advanced economies. So I think there's a whole new set of issues that come from that. We've, as was mentioned, we have put out what we call the Bali FinTech Agenda, working with the World Bank and at the suggestion of the Indonesian president. to try to provide a kind of a guide, preview of coming attractions there. Let me stop with what I've said, but I think it really is a very, very different frontier than we've seen in past years.
Thank you very much, David. Karnit, can I turn to you on your thoughts of how the financial system has evolved and perhaps a bit about whether it has become more inclusive?
So, as was said by David, I think there are a lot of new players coming in, so the system becomes less bank-dominated, and we actually, the new players provide services in a different way, and also to groups that maybe earlier on didn't have the same access to banking services. These non-banks, on the one hand, are subject to maybe different regulations. Sometimes there is there are lower barriers to entry, and also the regulation is still evolving, and in some ways they have easier time in providing credit, maybe not quite at the same standards as banks, and that sort of brings about some risks of regulatory arbitrage. In terms of inclusiveness, new players and also the competitive pressure that is exerted by their existence actually does give access to credit and to other services to households that otherwise would not have access. But there is also a different way of providing these services. It's more digital ways of providing services, and I think there are some groups that still don't have quite the digital proficiency to actually be able to consume these services. So I think these groups actually need to get the skills so as to get the services in the new ways that they're provided, both by banks and by non-banks. And that's a financial, it's the proficiency that has to be provided so as to help actually the new ways in which services are being consumed to actually have broader access to all the parts of population.
Thank you very much. Davide, can I come to you on how some of these trends that both David and Karnit have mentioned, and perhaps some other ones that you might want to focus on in terms of the financial system evolving in the coming years. And I think the role of non-financial institutions is going to be a big part of that.
Thank you. So if I start with simple numbers, global GDP today is in the range of $90 trillion. If you look at global financial assets, you're running about 3 times global GDP, so in the range of $270 trillion. Now, the banking system currently is enjoying the highest level of capital it ever had over the last 2 centuries. And hence, I think the huge success, of the Global Financial Stability Board, led by Mark Carney, with the support of the IMF and all the key central banks, has been that today we have a banking system that has never been as safe ever. Most importantly, the stress testing methodology, which is applied, so basically the regulators are applying a worse stress than we had over the last 2 centuries. So GDP collapse, 7-8% globally, like you had in the 29 crisis. You're looking at house prices down 20-30% globally, stock market prices down 50. So basically a scenario which is equivalent to 2-3 times the cumulative Lehman Brothers losses, not just of the institution, but macroeconomically. So the system can withstand a shock of $2 to $3 trillion. Yep. So you're looking about a huge amount of actual losses and withstand. Now, what's the cost of having such a strong financial system? Because risk still exists out there. Is that the risk has been transferred. To whom? Has been transferred by the central banks, which have engaged in $20 trillion of monetary easing. So each month, as you wake up, central banks are printing $100 million. Yeah? And they keep on buying assets. And what's happening is, who's holding these assets actually are consumer. savers, either in the 401k, in the insurance policy they hold, through mutual funds, through anything they held. And as a result, I think we're now at a time, as the system is being rebalanced, that it's important to understand that the imbalances actually are now being created by too loose monetary policy, and in particular by keeping negative interest rates. Why? Ultimately, borrowing equals taking someone from the future. You're indebting your kids or your own life or your future generation. And if you keep negative term structure with short-term negative rates, you're accelerating the incentive to borrow from the future. And because we are at a time where we're now 7 billion people on the planet, we're adding another 2, 3 in the next 30 years, eventually it gets to a point where even the planet cannot keep on borrowing from itself. And so I think it's time that we rebalance the financial system by slowly exiting this negative interest rates policy in the country and the area where it's still applied, because it's creating an imbalance itself.
Thank you very much, Davide. Alethea, can I turn to you now on evolving trends that we should be aware of in the financial system, perhaps a bit on the global economic integration that we have seen really significantly increasing over the past few years?
Thank you, Linda. Yeah, I'm going to focus on this idea of whether we are experiencing financial integration or financial disintegration. And this brings me back to the global financial crisis. Yes, it's good we're still there. We see a part of the financial sector further integrating, but we see parts of it that are delinking. I'm going to focus, of course, on the two largest, the incumbent and the new hegemon. Think about where we stand in terms of financial integration between China and the US. Again, from the global financial crisis onwards, we see this much larger financial sector in China, but not necessarily as integrated as we would have expected, perhaps since China entered the WTO. So if you think about this massive global SIFIs, mostly dominated by Chinese banks and the rest of the financial sector, which already have about 8% of their assets, I'm talking about banks now, invested abroad. That's quite an improvement from close to zero before. But on the other hand, if you look at the share of foreign banks in China, 1.3%, and actually decreasing from as much as double at the time of the global financial crisis. So you see kind of an imbalance. And this brings me to the idea that this happens at a point where we could start seeing, and we probably are already seeing, real delinkage, real economy delinkage, because of the trade war, because of even FDI. If you look at 2018, for example, already, China's FDI into China has plummeted. And you could argue that even Western FDI into China is also on the lower end of the equation compared to the past. So you start seeing signs of the linkage, starting with the closest part of the financial sector to the real economy, which is FDI. One wonders whether that will go beyond. And this is really the key question. Will a potential delinkage of the value chain and trade bring us to a financial delinkage, which we have actually never gotten to the point which was as high as it was for the real economy? So will we end up with something much more separate than we have to? Think about trade, think about, infrastructure, payment system. Could we end up having two different worlds in the financial realm? And I think this is a very important question going forward for the future of the financial sector.
Thank you. So that leads me to you, Ryozo. It sounds like some of these trends are certainly raising issues around financial stability. And perhaps you can also say a word about the evolving trend around demographics as well.
Thank you, Linda-san. Coming from Japan, which is the front runner in longevity, maybe let me focus on aging and touch upon financial stability as well. Well, indeed, Japan is experiencing a rapid aging, and also, for example, 50% of the babies, Japanese babies born in 2007, is expected to live beyond 107 age if the current past trend continues. But it is not the issue for Japan or the advanced economies. The speed of aging is even more rapid in emerging or developing economies. And there is certain forecast. In 2015, there would be 2 billion people above the age of 60. So it is a problem for everyone. And often the aging is discussed in the context of public finance. But I think it would have a major impact on financial system as well. It has more broader financial system implications, and it would have more micro inclusion type of aspects. And in macro elements, the Japanese regional banks are already facing the need to redefine their business model, facing a shrinking local community. And some of the Japanese financial institutions are thinking, incorporating the factor whether SME got a successor or not in credit risk assessment. But perhaps more importantly, the aging would change the composition of the household portfolio. For example, by 2035, 15% of the household holding of stocks and bonds in Japan will be in the hand of someone with dementia. So it would affect the whole risk-taking capability of the household
Probably
portfolio.
a little bit, yeah.
Okay. So there are financial stability and economic implications, but there is also a inclusion aspect. As Governor Fluke said, fintech can be a help, but at the same time, it can mean a digital divide for aged people. And the need for aged population is different from younger generations, and the current product line not necessarily fully cover the need and the risks which need to be covered of the aged population. So I think there should be significant change in the financial industry. Well, I cannot predict it, but I think the future financial services in the aging society should possess 3 qualities: customized, cross-sectoral, and transparent. Customized means the condition of aged household, aged population differs significantly. Some are working, some are in the hospital. It needs to be customized. And it needs to be cross-sectoral. The financial need and the non-financial need, like medication or elderly care, closely linked. So we need to design services cross-sector-wise. And the transparency, I'm not talking about the specificity of the product, but transparency in what this product or service mean to you in your life planning. That type of transparency would be needed. And these are something where fintech can be good at. So I'm optimistic, but there should be significant transformation in macro financial systems and also micro financial services.
So just to follow up, what should policymakers do to support these 3 aspects that you've highlighted?
Yes, I think maybe several things can be done. The traditional regulation is focusing on industry difference. We regulate banks, we regulate life insurance, casualty insurance, asset management, but maybe some disintegration and reintegration may be needed. So fintech as a whole is requiring regulator to move from entity-based regulation to activity-based regulation. And that would help us cope with aging society.
Okay. Thank you very much. Alethea, let me come to you on what you think policymakers should be doing to respond to the trends that you've identified around potential disintegration.
Well, if we are thinking of an increasing disintegration in the value chain, which was the point I was trying to make, and how can that may affect first trade finance, particularly, and also going beyond other aspects of finance, in particular FDI, I think the only thing we can think of is to basically go beyond what we've already done in terms of multilateralization. We've gone very far for trade. It seems it hasn't worked. But we've never gone as far for FDI. And I wonder whether we should not be taking steps before it's too late and trying to come up with better guidelines to make sure that we are ready before it actually happens. Because it's very, very hard to think of a world where the real economy, trade in particular, the value chain in particular, start to be delinked, and finance does not react to that reality. So we should basically start working on that at a multilateral level. Yeah.
Thank you. Davide, let me come to you. You are obviously one of our market participants in the private financial sector. What do you think policymakers should do to better address systemic risk going forward, given some of the developments that we've already discussed?
So I think the key systemic risk right now is in the market and currency infrastructure. So let's take the planet as a whole. Today, 80% of global savings are managed by what I define an Anglo-Saxon institution, whether it's American or British. Today, 50% of global trade higher is cleared in dollars. Rating agency, protected by the Second Amendment in the United States, have a massive monopoly in deciding who gets access to credit and who does not. So today, if you look at the globe as 100, I see the US dominating 60 to 70% of global savings. The regulators, by allowing the rating agency to be basically the plumbing of the system, in my view, has handed too much power to the US. Now, since 1945, the US has been the beacon of democracy and protecting global interest citizenship. But as we've noticed recently, things might not be given for granted, even for the US. And hence, I think the key is to reestablish check and balance and making sure that savings are invested globally, not necessarily with a dollar eye. Can I make an example? When the US has decided in a way to weaponize the US dollar by going extraterritoriality with fines, in the case of BNP, they were lending money to proper oil company in Iran, and they were fined $10 billion by the DOJ. Under EU law, they were absolutely fine. Suddenly, they're not any longer fined for US law. And so I think in a global world, this needs to be kept into consideration, and we cannot give for granted that what has worked so far will work in the next 20, 30 years. Because what's going to happen if tomorrow the trade tension gets passed to the financial sector? What happens if tomorrow BlackRock is being told you cannot invest in China? What happens if tomorrow we put a 30% tariffs on the largest insurance company for investing in Europe? Because as they're intermediating also other people's citizen savings, the arbitrary decision will affect these institutions. The second point I make quickly is on fintech. I'm extremely worried about the regulators allowing data from financial institutions to be handed to fintech. How many times have JP Morgan accounts or BNP Paribas or Bank of Tokyo Mitsubishi been hacked over the last 45 years? None. How many times have Facebook or the similar been hacked daily? Well, let's be clear. The day you're going to have these over-the-top or digital company be able to take your individual data out of financial transaction, you're running massive risk. And so I think here this idea that tech is great and banking is old, the tech is fantastic and bankers are bad, I think will not serve public policy and will only increase systemic risk going forward.
We don't think bankers are bad in this room. Okay. Karnit, can I come to you on how you've heard what the others have said? How do you think policymakers should be responding to both the opportunities but also the challenges posed by this evolving financial system?
So I think generally regulators should deal with old risks but also with new risks. But the way to deal with risks is not by holding back on the adoption of technology. I think there is a lot of technology which is efficiency enhancing both within the banks and outside the banks. And I think regulators and bank supervisors don't generally sort of have the type of expertise to regulate those, but they have to acquire those expertise to make sure that they can actually support the adoption of new technology by banks while also regulating and making sure it's safe. I think you also have to make sure that you deal with these new risks that are associated with the new technology by having the right ability to deal with cybersecurity and other types of risk associated with the new technology. By the way, within the Bank of Israel, we have banking supervision, and we actually set a unit which is called Technology and Innovation, which helps banks adopt new technology while managing the risks. Another aspect where I think regulators should move towards is actually helping banks to deal with legacy systems. They have a lot of labor that maybe has to be reduced. There are branches that maybe some of them can be closed. By the way, we have to help some of the population, the older population, to actually be able to move towards the digital way of consuming services and also updating the IT systems. And I think there are ways to actually provide incentives for banks to sort of deal with their legacy systems and become more efficient. Another aspect where regulators should make sure that they're aware of is that some of these new players, including credit providers, have not been around through a full cycle, a full economic cycle or financial cycle, and we have to see how they actually manage and how they use the information to assess credit risks and how it works also through a downturn. So I think there needs to be a very close monitoring and also some adjustment maybe of the regulation. And the last element, which is related to what you said, we still have a regulatory system which looks at institutions rather than activities. And I think different institutions now provide similar services and engage in similar activities. So the minimum is to have some coordinating body which looks at the different activities, including, for example, a financial stability committee that needs to monitor and make sure that there are no regulatory arbitrages created, and if there are, they need to be diminished, and you have to look at the system as a whole. Just one example. For example, we apply macroprudential measures, but most of our macroprudential measures are applied to banks. And what may happen is actually that activity is moved to the less regulated parts of the system where you don't have the right prudential tools, or we have not developed them yet. So I think you have really to look at the system as a whole and make sure that no regulatory gaps are being created in these processes.
Thank you. Before I give David the floor to give us his take on policymakers and the role of international coordination, I just want to point to the two microphones which are in the aisles. We'll have just a few moments to take some questions from the audience. So if you are interested in doing so, perhaps you can make your way to the microphones. in the next couple of minutes. But David, I wanted to give you the final take on these issues around what policymakers should do, but specifically the role also of international coordination.
Sure. I think you posed an extremely difficult question, and quite a lot can be said. But let me give, in a sense, three categories of answers. The first is that we know that financial intermediation broke down, and that in this upcoming period it's going to be really important to have a strong and robust system of financial intermediation, and that with technology and other changes going on, we need to allow experimentation. We need to find ways to, and if the banks aren't going to be the risk takers as they were, we need to find institutions and ways to promote financial inclusion, to deal with the demographic changes, both domestically. Banks in Japan are already doing quite a lot to find ways to cater to the older people. But also, when one thinks about the demographics are quite opposite in Africa. There are many, many young people, and so you're bound to have lots of savings in one place and lots of need for building capital to put people to work in another place. So you need international intermediation to be functioning, and I'm not sure we have a clear picture on how that's going to go. So enabling new approaches, including all of the fintech approaches, I think we will find that there are risks, but if we don't allow experimentation, we'll never know what the opportunities and the possibilities are. Then, it's public policy makers' job to worry about the risks. We've talked about the risk of financial instability. We've talked a little, but we need to talk more about the risks of the protection of data and the integrity of data. More and more we see that operating systems, that payment systems are now migrating to new places, and so there are operational risks that come along with that. And then, we know that some banks were too big to fail, but now we have a cloud that may be too big to fail. We have, forms of concentration in the new tech firms, and in some countries, the new internet platform firms are becoming financial firms. So the question of whether there are market concentration issues or maybe natural monopoly issues is important. But then to come to your last point, I think we may well see fragmentation, because some of the as experimentation happens, some parts of the world are going to be more willing to allow things to be tried than other parts of the world. And for example, I think the big internet platforms in China that are engaging in fintech are being allowed to do certain things there that will not prove acceptable in the U.S. or in Europe. So we run the risk that however much trade may be segmented, finance and the infrastructure may be impeded. Davide may be right that the U.S. May impede others in a way that leads to a desire for a more multipolar financial system, and that may evolve. And if that's the case, I think that's probably to some extent going to be the case. We'll need more international cooperation to make sure that incompatibilities don't arise that would lead to either inefficiencies or financial stability risks.
Thank you very much. I'm going to turn to the floor. If I could ask you to please introduce yourself, who you're with, and if you could ask your question briefly, I'll make sure that we get both of you in. So let's start here.
Founder and president of the Future Society, which is a think tank dedicated to the governance of emerging tech. What I take from today is partly a tension between the urgency of innovation for development and the need to stabilize, and it really came strongly. You've discussed tech giants. I would like you to bring into the fold unicorns. And to put the question in a form of a provocation, kind provocation, is the movement of the unicorns the result of a regulatory arbitrage, which is that unlike banks, other institutions which are funding innovation and channeling a lot of capital to them, let's say, are less regulated than other financial institutions? And should we fear this movement as the expression of a form of a bubble, given how interconnected is the global financial system?
Okay, thank you very much. And the question here?
Abe from KPMG. My question is related to Bitcoin. How does the panelists see Bitcoin in the future of finance?
Super, great. Okay. So let me pose to the panel who would like to take the question on unicorns. These are unlisted billion-dollar companies, and whether there's a bubble. David.
I'll say one thing, which is that surely if there's uneven regulation, there will be regulatory arbitrage. And so surely some companies will not hold capital if they don't have to. And that's problematic. And in China, where the new big internet platform companies are getting into finance, China is realizing that if you act like a bank, you have to be regulated like a bank from the standpoint of, for all of the different standpoints of capital, liquidity, and proper behavior, fit and proper ownership, and all of that. But that's not to suggest that there may not be efficiencies in these new fintech ventures that would survive even if there was a level playing field. I don't know this area well, but if you talk to the Chinese companies, they tell you that because they see not only your purchase history the way Amazon might, but they see who your friends are, like Facebook might, they can figure out with AI a lot more about how creditworthy you are than a bank that doesn't know who in the world you are, except that you once filled out an application on one piece of paper in a bank branch. Mm-hmm. And so one would think it's conceivable that there are, in fact, efficiencies in the allocation of resources that could be made. Now, perhaps there's a way to, there are obviously there then are all kinds of issues around whether there are other problems, including conflicts of interest issues and market concentration issues. There are all sorts of issues about whether you want to allow those companies to be in some sense like banks, insurance companies, asset management companies, which they are becoming, or not. But perhaps the potential of fintech is that the combination of having more information and having AI may allow for efficiencies. And if I could just intrude on the Bitcoin, I mean, Bitcoin is one thing, but distributed ledger technology or some variant of it may provide efficiencies too, more in, it doesn't yet, and it may be that we end up with, let's call it semi-distributed ledger technologies, but the ability to use technology to register property rights, what you own, and when you buy or sell something, let's say it's an asset, to quickly, efficiently transfer title and keep track of it, that may be an efficiency that also is an important one. And we may need to allow experimentation to run for a while to figure out how that can best be done, as well as how it ought to be regulated, because obviously in Bitcoin there are all sorts of other issues like investor and consumer protection issues, various others.
Thank you. Yes, please.
Let me respond focusing on Bitcoin and other crypto asset issues. What regulators should do? There are 4 options. Prohibit, like China, India, Russia, Indonesia does. Regulate, like Japanese do. Monitor, like a Financial Stability Board has started, or ignore. Which to choose, there is not yet
maybe not 4, maybe not ignore.
Yeah, 4th one, at least for money laundering and anti-terrorist financing-wise, ignore is not an option already. But in order to deal with the issue, there is already many works going on under the instruction of the G20 ministers and governors. But Japan FSA is proposing to the global regulatory community to do something more. And this is important because not just crypto assets are necessarily important, but it indicates future challenges, new services, products, and the traditional regulatory framework dissonance. It's a kind of a precursor in identifying issues. We are proposing three things. First, various standard setters are doing their work. Financial stability, FSB, customer protection, IOSCO, money laundering, FATF, risk weights for bank holding, Basel Committee, use for payment, CPMI. But there is nobody to put together all those pieces into a consistent package. And
I think that's a new role for the IMF now.
We have nothing else to do.
I don't recommend that for David, but someone needs to do it. And for example, the Bitcoin in many jurisdictions do not fall in the definition of securities.
Sure.
So IOSCO doing market integrity, but Bitcoin market integrity, nobody's business. So we need to identify gap and start to address it. And also, there is a need for cooperation, but we don't know who is doing what. So we are proposing to come up with a crypto regulators directory across the globe. But maybe more importantly, we need to find out new approaches. Traditional regulation is to do it from above and catch middlemen.
Yeah.
But Bitcoin, 100 developers, 11,000 nodes, we don't know who they are. Maybe we need to find out a way to engage in a multi-stakeholder approach like telecommunication ministry does do in internet governance.
Thank you very much. We are out of time, but I thought it was an absolutely fascinating panel. If I could steal 1 minute, I promise, I see the director over there, 1 minute, instead of me summing up, I'd actually like to get the panelists to give me their one change they would like to see in the financial system in 10 seconds. Easy task. Davide, we'll start with you.
So for me, the most important changes is to ask credit and fixed income investor to run their own credit analysis and not just rely on rating agency.
Okay.
And this should be a prerequisite in order to allocate capital in a decentralized and multi-follow way.
Thank you. Alethea.
Yeah, I would say do our utmost to avoid financial disintegration, because that trade war is a piece of cake compared to what we would be experiencing if that were to happen. So we better think about how to avoid it as far as possible.
Ryozo.
Thank you. The biggest financial stability problem in the current world is that the global economy, it seems it cannot attain full employment and get out of deflation without continuously adding debt to household or corporations or the government. We cannot continue like this if we are to sustain the financial stability. We need to find a way how we can change the situation.
Thank you. Karnit.
Don't hold back on innovation and change, but be aware of the risk and manage them.
Thank you. David, final word.
I will surprise everyone by saying maintain a strong IMF.
Of course. That's a given.
And FSB and BIS, because we need multilateral cooperation given the inevitability that there are going to be forces of fragmentation. We didn't even talk about the risks that cyber attack may pose to integration. There will be risks of fragmentation and uncoordinated policy response, and those could really be to the detriment of maintaining good, efficient intermediation that's needed for the growth of countries around the world.
Thank you. I thought that was a fantastic
We have one more.
discussion.
Did you? Oh, you had.
She went. I think this was a fantastic discussion around some of the challenges, some of the future trends we should be watching, and I know I personally feel reassured that because of dialogues like this, that we will be in a financial system that will aim to be both safer, but also allow experimentation and support economic growth. And I think that would be one of the best aims to come out of forums like this. And it's very great to have had the participation of a fantastic panel to start this conversation. I'm sure there will be many more to come. So please join me now in thanking this terrific panel, Riozo, Carnett, David, Alethea, and Davide, who's given us their take on the future of finance. Thanks to all of you for being here as well.